You think the most secure financial institutions could withstand a crisis. You think that a billionaire running a global empire built on digital gold had it all figured out. You're wrong. Picture this: a company once valued at over $30 billion, seen as the future of finance, evaporating almost overnight. Imagine millions of people logging in, watching their life savings disappear like mist. A hero of innovation turns out to be the architect of one of the largest financial crashes of the 21st century. What if I told you that trust, not failing markets, was the real currency that collapsed? This is the shocking story of FTX. FTX, short for Futures Exchange, was a cryptocurrency trading platform that exploded onto the scene in 2019, founded by young entrepreneurs Sam Bankman-Fried and Gary Wang. It promised a safe, easy, accessible gateway into the burgeoning world of cryptocurrencies. At its height, it had over 1 million users and was ranked as the third largest exchange by trading volume in the world. FTX was headquartered in the Bahamas and marketed globally. Its native token, called FTT, became a cornerstone asset for the company, its investors, and users alike. Investors poured billions of dollars into FTX, believing it was a stable, trustworthy giant in the crypto ecosystem. But that image, as we'd soon find out, was built on shifting sands. FTX's rise was meteoric. It wasn't just an exchange, it was a brand. It signed sponsorship deals with major sports franchises and even appeared on mainstream media. Venture capital firms publicly backed the company, valuing it at up to $32 billion before collapse. Investors didn't just hand over funds, they handed over confidence. But beneath the surface, the company's corporate controls were dangerously weak or non-existent. When a new CEO was installed after bankruptcy, he described what he saw as the most complete failure of corporate controls and absence of trustworthy financial information in his decades of experience handling major bankruptcies. In plain terms, the books weren't audited properly, cash flows weren't transparent, and basic risk management systems didn't exist. One of the most significant flaws at the heart of FTX was its relationship with a sister company called Alameda Research, a trading firm also controlled by Sam Bankman-Fried. In theory, this could have been a legitimate working relationship, a trading desk helping to create liquidity for FTX's markets. In reality, investigators later found that huge amounts of FTX user funds were secretly moved to Alameda to cover its trading losses and other obligations. FTX and Alameda operated like two halves of a shell game. Customer deposits, money people thought was being held securely, were used as collateral for Alameda's high-risk bets and loans. When questioned later, bankruptcy court filings revealed that substantial portions of the company's assets had been lent out internally in ways that weren't disclosed to users or investors. In one stunning example, Alameda reportedly made a $1 billion loan back to its own CEO, according to court testimony after collapse. When an enterprise is built on such internal cross-leveraging without proper oversight, the moment of failure doesn't arrive slowly, it explodes. On November 2, 2022, a report from industry publication CoinDesk dropped a bombshell. Alameda Research held a substantial portion of its assets in FTT, the very token issued by FTX itself. This meant the value of Alameda's holdings was tightly tied to confidence in FTX, a circular dependency that should have raised red flags. Almost immediately, another crypto giant, Binance, announced it would sell its billions in FTT tokens, citing concerns over the balance sheet of FTX and its affiliated companies. That announcement triggered something akin to a bank run, but for the digital age. In just 72 hours, customers rushed to withdraw more than $8 billion from FTX. Except FTX didn't have that money. When traders and everyday users started redeeming their funds, FTX couldn't fulfill the requests. The platform simply didn't have enough liquidity, real withdrawable assets on hand to cover all the promised balances. The greater the panic, the faster people withdrew, and the deeper the hole became. In a traditional bank run, depositors line up at brick-and-mortar branches. In FTX's case, users typed commands into apps and watched their funds vanish from the system. Some of those user deposit balances weren't even properly recorded on internal balance sheets. Others were mingled with trading assets at Alameda that had lost value. This mismatch between what was owed and what was actually held was gigantic. And when the truth came out, trust broke first, and then the market did. On November 11, 2022, FTX, along with Alameda Research and over 100 related entities, filed for Chapter 11 bankruptcy protection in the United States. Sam Bankman-Fried resigned as CEO, replaced by turnaround specialist John J. Ray III. In his sworn declaration to the bankruptcy court, Ray would later say he had never seen such a complete failure of corporate controls, pointing to missing records, poor accounting, and lack of basic financial oversight. The bankruptcy process was vast, involving billions in missing assets, tangled international subsidiaries, and millions of users desperate for restitution. Many people whose savings were parked on the exchange found themselves with limited ability to withdraw their own funds, let alone recover losses. Less than a year after the collapse, Sam Bankman-Fried stood trial in the Southern District of New York. In November 2023, a federal jury found him guilty on 7 criminal counts, including wire fraud, conspiracy to commit fraud, and conspiracy to launder money. Prosecutors argued he orchestrated a deliberate scheme to deceive customers, investors, and counterparties. In March 2024, Bankman-Fried was sentenced to 25 years in federal prison and ordered to forfeit more than $11 billion in assets, an amount designed to help repay those who lost funds through FTX's collapse. Several other executives, including the former head of Alameda Research, Caroline Ellison, also faced criminal charges, pleaded guilty, and served prison time for their roles in the scandal. Even law firms that had advised FTX were pulled into lawsuits from customers and regulators who claimed they helped enable regulatory loopholes. FTX's collapse was more than an isolated failure. It rippled through the global financial landscape. Market prices plunged. Major cryptocurrencies like Bitcoin and Ethereum saw significant price drops during the crisis as fears sparked a sell-off. Regulatory scrutiny intensified. Policymakers worldwide pointed to FTX as evidence of the need for stronger oversight in crypto markets. The crisis became a central talking point in legislative discussions about crypto regulation, not just in the US, but internationally. Investor confidence shook. Institutional and retail investors alike became more cautious about unregulated exchanges and the safety of digital assets held off-chain. Some firms now require more transparent proof of reserves after similar failures. Everyday losses were real. For many individuals, losses weren't just abstract numbers. Thousands of retail investors around the world were left with thousands or even hundreds of thousands of dollars tied up, often navigating confusing liquidation and claims processes. When we trace the collapse to its core mechanics, several themes emerge. Misuse of customer funds, lack of internal controls, conflicts of interest between related entities, and inadequate disclosures to users and investors. Regulators and prosecutors allege that the crisis was not merely a failed business, but a fraudulent scheme woven into the very fabric of FTX's operations. That allegation is reflected in the criminal convictions and massive forfeiture orders issued by the courts. The collapse left powerful lessons not just for the crypto sector, but for finance as a whole. Financial platforms must maintain clear segregation of customer assets. Transparent accounting and oversight aren't optional, they are fundamental. Rapid growth and public praise don't guarantee institutional integrity. Regulatory gaps can be exploited, and when they are, the costs are real. This wasn't just a company that failed, it was a warning sign that innovation without responsibility creates fragile foundations. As of today, FTX remains in bankruptcy liquidation, and recovery efforts continue to determine how much capital can ultimately be returned to creditors. Sam Bankman-Fried is serving a long federal prison sentence. The scandal remains one of the defining financial collapses of the digital asset era. The collapse of FTX wasn't just the fall of a company, it was the crumbling of a digital financial dream, influenced by unchecked ambition, inadequate controls, and misplaced trust. Millions were affected, billions were lost, and an entire industry was forced to confront what happens when innovation doesn't go hand in hand with sound financial governance. In the world of high finance, success is often celebrated. But as the FTX saga shows, the cost of success can be far greater when the foundations beneath it are unstable. Please subscribe to Cost of Success for more deep dives into the biggest billion-dollar business failures and the real financial mistakes behind them.